What is the impact of purchase of fixed assets on current ratio if cash is used for purchase or it is availed or purchased on 6 months credit basis? To understand the impact, let us first create a present current ratio scenario. Look at here, there is a current asset of 100, let's say 100 crore, and current liability of 75 crore. If I calculate current ratio, now it will be 100 divided by 75 and it is 1.33. Now going to the situation 1 where the cash is used for purchase of fixed assets. So when the cash is used, then to that extent there will be reduction in current asset. Let's say the fixed asset purchased is worth rupees 50 crore. It means current asset will come down by 50 crore and fixed asset will get added by 50 crore. So here in the place of 100 you will have 50 and current liability is going to remain the same. So now if you calculate the revised current ratio, it will be 50 divided by 75 and obviously the value will be less than 1. So the understanding is when the current asset, in this case cash, is used for purchase of fixed asset, then obviously there will be drop in current ratio, which we can see here. This happened because the existing resource is used for acquiring the fixed asset without bringing in fresh funds. So answering the first question, what will happen to the current ratio if cash is used for purchase? The answer is current ratio will drop. Next one, what will happen to current ratio if fixed assets is purchased on 6 months credit basis? Here purchasing on 6 months credit means that liability have to be repaid within a period of 1 year. So that liability is current liability. Let's say fixed asset worth 50 crore is purchased. Since it is purchased on credit basis, it will be appearing under current liability. The obligation will appear under current liability, basically creditors for fixed asset, and that 50 will get added here. So 75 plus 50 total current liability will become 125. So this was the original current ratio. Now if you calculate the revised current ratio, it is going to be 100 divided by 125, and here also the ratio is going to be less than 1. And here why the ratio has dropped? Here the ratio has dropped because a fixed asset has been acquired without bringing in sufficient long-term funds. Look, the obligation is creditors for machinery and that is short-term in nature, which has resulted in increase of current liability and drop in current ratio. So let's conclude. The impact of purchase of fixed assets on current ratio if 6 months credit is availed for purchase will be a drop in current ratio because there is no corresponding long-term fund infusion for acquiring the asset. If you wish to learn more like this on credit and financial analysis, I invite you to check our credit and financial analysis mastery course. And here we go. Credit and Financial Analysis Mastery Course. It's a comprehensive pre-recorded online course that comes with 15 modules of video lectures, basically 70 plus hours of video contents, multiple ebooks and reading materials related to credit and financial analysis that will make up another 30 plus hours of content. So totally it is 100 plus hours of learning resources. Then you will also get access to a private community in Telegram for clarifying your doubts in credit and financial domain. Then you also have the flexibility to choose 1 year subscription or lifetime subscription depending upon your learning goals. So by joining this course, you will learn basics of credit analysis, how to read balance sheet, financial ratio analysis, cash flow, fund flow analysis, how to arrive at credit risk rating, how to prepare CMA report, cash budget, how to assess credit facilities like CC, OD, LC, BG, term loan, how to write bank loan proposal, and you will also have access to case studies related to credit analysis. So to join this course, to know more about the course, comment CFA, and I'll share the details with you.